following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today on either 94.1 FM WNBU or Cable TV 10 in New Bern. You also may be on our website, www.dlblain.com, listening to the audio or streaming our videos. We welcome you to the show today. We've got a lot of good topics, a lot of interesting stuff happening out there in the world today, a lot of it surrounding tax policy. We'll get into a little bit of some tax strategies. We'll look at some things that are happening in the investment world as well. But first, before I do, this was a recent tax court memo. I don't know what you all do in your free time, but I read things from the tax court. There's the legal system where criminals go in the United States. There's also a whole system of courts called tax court, where taxpayers that have a dispute with the IRS, they go to tax court. And unlike regular court, tax court has a little bit different rules and things like that, and attorneys, CPAs, enrolled agents, different people can represent taxpayers in tax court. Well, anyway, there's a few lessons in this court, this case that I'm going to talk about to pick up. Then, essentially, the taxpayers were denied a $25,000 charitable deduction because they failed to follow some very specific procedures. So, here's the facts of the case. They deducted $25,171 in charitable contributions, most of it to their church. And the IRS sent them a notice of deficiency disallowing their contribution. Now, the case doesn't say why they initially denied it. But anyway, so the taxpayers produced records, including canceled checks and a letter from the church acknowledging the contribution, and they sent it in. Now, the IRS did not accept the acknowledgement letter from the charity because it didn't provide a statement that said whether any goods or services were provided in consideration for the contributions. That's one of the rules. So the taxpayers went back to the church and said, hey, the statement you gave us, it needs to say this, 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 and this. So they produced the second letter. It contained the same information, but it just had a statement at the bottom that said no goods and services were provided. Now, then the IRS did not accept this second letter because it was not contemporaneous, meaning that it was not sent out at the same time that the donation was made. So the rule says that no deduction shall be allowed for any contribution of $250 or more unless the taxpayer substantiates the contributions by a contemporaneous written acknowledgement of the contribution by the donee organization. And for donations of money, it must state the amount contributed, indicate whether the donee organization provided any goods and services, and provide a description and good faith estimate of the value of any goods or services. And then it further states the acknowledgement must be contemporaneous. And what that means is that has to be obtained by the taxpayer the earlier of the date the taxpayer files the return or the due date, including extensions. So anyway, what happened was these people, they did donate $25,000 to their church. Legitimately, nobody questioned whether they actually gave the money. And this is the key, and this is what I want you to take away from this, is that nobody questioned that they gave money to their church. Nobody questioned the church was tax exempt. It's just that they failed to get a written acknowledgement that had the appropriate documentation on it. And then when they did, it was no longer contemporaneous. So they denied the tax deduction. I mean, to me, yeah, that they did. The letter of the law was, it was a little bit shady there. But anyway, that's who's going to be running your health care penalty in the future, the IRS. Anyway, the lesson is make sure that if the rule, that you know what the rules are and that you follow the rules, because by the same token, this court here ruled against the taxpayer, but I have seen other cases where the taxpayer followed the exact rules that the IRS had written out, and the IRS tried to argue that, well, yes, that is the way the rules were written, but what we really meant was this, and it was ruled in favor of the taxpayer. So anyway, interesting case. Here's another thing that I saw, and immediately I started thinking to myself, I bet you some people are going to wonder about this. So Facebook founder Mark Zuckerberg, I don't know if you heard about him. We talked about him on the show before. He's the, I don't know, 10 or 20 wealthiest people in the world now. He just refinanced his house. This is available through public documents. And he got an adjustable rate loan that started with a 1.05% rate in May. And the current, and so that's just an extremely low rate that he was able to refinance his house at 1%, 1.05%. Now, it was a variable loan, and this is where the lesson comes in for everybody listening here is I don't particularly think that these variable rate loans are very good for everybody. It doesn't say in this article, but I remember reading, I believe that his monthly mortgage, I can't remember how much it was, but anyway, so he borrowed the money on this adjustable rate mortgage that it's going to vary with the rate of interest. So essentially he's betting that rates don't go up anytime soon. For most people, most middle Americans out there, a fixed rate is the way to go. But this kind of points out that he was able to borrow money at 1%. The inflation rate over the past year was about 1.7% through May. So he's able to borrow money at less than the rate of inflation. And so that was the other point, is that somebody that has the net worth, I mean, he could have paid cash for the house. Why would he go out and borrow? And this is the same thing we talk to our clients about sometimes, is that he's able to borrow 1.05%. It's below the rate of inflation. Why would you not borrow it, especially when you have the money set aside that if rates go up, he can just pay it off? So it's a big difference when you're out there borrowing money and you have the money to pay cash for something. It's a whole different equation. When people go into debt, money they don't have, they overpay, adjustable rates, these type of things, and they don't have the money, it's a different equation. But this just illustrates a couple of points that, number one, there are times and places when borrowing is appropriate, and it also points to the fact that, well, an adjustable rate mortgage for most people may or may not be an appropriate strategy. Well, we're coming up on our first break. When we come back, we'll wrap up with this and move on to some other topics. So for All Things Money, I'm your host, David Blain, and we'll be right back.